Hi everyone and welcome to this session on alternative investments. In this particular session what we're going to cover is suitability and recommending alternative investments. This session has been accredited by the Chartered Insurance Institute for continuing professional development, so if any time you spend on this particular presentation counts towards your CPD scheme. My name is Daniel Kiernan, I'm the presenter today, and we're going to have about a dozen or so slides and it's going to take about 20-25 minutes to get through all of the material. So here's today's agenda. We're going to start off with the FCA view, the view of the regulator. Seems a very sensible place to start, obviously. It defines how all IFAs and advisors have to think about alternatives when they're recommending them. We'll also look at the concept of appropriateness and suitability and the differences between those two concepts. We'll also discuss some products that escape the latest set of regulations, PS 1303, and we'll move on to the implications of those rules for professional regulated advisors and also for non-regulated professional introducers. And then at the end we'll take some questions, summarise and let you know what the next steps are. Okay, so we'll start with the FCA view. The FCA do have quite a negative view of alternative investments. That's really come about because there have been some high-profile investment failures, such as sustainable agro-energy, Harlequin property investments, not quite a failure yet, but it's been very, very controversial. There's been some evidence of mis-selling of alternatives. The FCA have been very concerned with the way alternatives have been distributed, particularly by non-regulated salespeople. So the FCA thought it was best to step in and take a look at this area of the market. And in autumn 2012, they released CP 1219, which was a consultation paper proposing some changes to the way that alternative investments are distributed. And that was formalised in spring this year, spring 2013, with PS 1303. Those papers focused in on UCITS, unregulated collective investment schemes, and non-mainstream pooled investments. So a UCITS, an unregulated collective investment scheme, the name's actually a little bit of a misnomer. There is some regulation in there. A UCITS has to be run by an authorised operator. So there's an authorised operator in there, but the assets that are held within the scheme are not necessarily regulated assets. It might be property or farmland, something more esoteric like fine wines or fine art. So they're not mainstream investments, they're not regulated investments. So UCITS sits in a little bit of a grey area where there is an authorised operator. You do have to be authorised by the FCA, but there are unregulated assets held within that scheme. And then they also introduced this category of non-mainstream pooled investments. And they left this quite vague, and I think that was deliberate actually, to try and capture as many of these non-mainstream and as many of these esoteric investments as they possibly could. But what they really focused in on were, as well as UCITS, QIS, qualified investor schemes, TLPIs, traded life policy investments, and securities issued by SPVs, by special purpose vehicles. Now these were designated investments that the FCA actually regulates. So I think that's why there was a focus on these categories of investment in particular. A qualified investor scheme, it has the same sort of structure and setup as an authorised investment scheme, but it has much lighter regulation. It can borrow much more, for example, so it can take on much more leverage. So for that reason, it's considered to be a little bit more speculative, and it should only be open to what's termed qualified investors. The difficulty with this was that the fund manager of these schemes, the managers of these schemes, they would really struggle to identify whether the investors actually qualified for the scheme or not, particularly if the QIS was held on a wrap or a platform or something like that. the fund manager would be several steps removed from the consumer at the end of the chain. So the FCA have shifted the emphasis a little bit, and now it is the emphasis is upon the intermediary who introduces the consumer to the investment to ascertain if they are suitable and if they are a qualified investor. The other one on there, traded life policy investments. These are US life insurance policies that can be sold on. They have been marketed as low-risk investments, and the reason they were considered low risk, or some people considered them low risk, was because they are completely uncorrelated with the wider market. They pay out when people die, so it's quite a morbid kind of investment. But obviously that's completely uncorrelated to what's happening in the equity market or the fixed interest markets or the property market. So it was an asset class that gave you very, very good diversification benefits, but the terms and conditions were very opaque, the investment structures were very complex, they're very difficult to understand and to assess the risk of. So the FCA's view was, yes, these may be uncorrelated and good diversifiers, but they are by no means low risk. So these were included in PS 1303 as well. And then the other area they looked at was special purpose vehicles. These are SPVs that have been set up. You can set up a special purpose vehicle to do some trading, but they were particularly concerned with SPVs that were set up just to securitize assets. And their feeling was that it was just another way of having something similar to a UCITS, just a particularly different legal structure. And so their concern was that there would be regulatory arbitrage. If they just put the new rules out and applied them to UCITS, people would just switch to using SPVs. So they included SPVs in the new rules as well. What the new rules stated was that these investments were only going to be considered suitable for high net worth investors or for sophisticated investors. Some of the other reasons that the FCA felt these investments were too risky for ordinary retail investors. Very often they featured complex or opaque investment structures. The features, the terms and the conditions were complicated and difficult to understand. For example, perhaps you would be buying a lease on some land, maybe some plantation in Australia, something like that. So you might be purchasing a sublease, not a freehold, not even the main lease, but a sublease. And then you would always be signing a separate contract to employ a management company who would exploit that plantation or whatever it might be. So you can see how with several leases involved and different operating contracts, very quickly you could have some complex terms and conditions attached to these kinds of investments. Very often they're also speculative and high risk. The underlying assets, it might be, let's say, an off-plan hotel in an unproven area. Perhaps we don't know if it's going to take off or not. So potentially they can have very high returns, but it is something that is speculative and high risk. Another issue was no secondary market, and the investments might be very illiquid. For example, many kind of alternative property investments are based on fractional sales of hotel rooms, but we don't yet know, it's quite a new concept, we don't yet know if there's going to be a big secondary market for fractions of hotel rooms. So that means that there isn't an established secondary market, and the investments can be very illiquid. They can be very illiquid anyway. If it's property, if it's land, anything like that, it's not something that can be sold in a hurry. It's not something that you can sell in small chunks. You've got to put the whole thing on the market and you've got to wait and find a buyer. So this was another risk attached to these investments. It's not something you could get out of in a hurry. You were making a big commitment and you may find yourself tied up in that investment for a long time. The assets might also be particularly hard to value because something is illiquid, because there's no established secondary market. It might take a while for the market to find a price, or very often in these kind of schemes, the underlying assets themselves required some specialist knowledge to value them. So for example, you might have a UCITS or some sort of bond that was investing in fine wines, classic cars, fine art. All these sorts of things are very exciting and interesting, but of course you need real specialist knowledge to be able to value these sorts of things. So that was another risk that the FCA thought was attached to these kind of investments. Because they are not regulated, they're held up to much lower levels of scrutiny. So this is another risk that's attached to these kind of investments. The marketing literature may be very heavy on the benefits of the investment and very light on the risks. It may overstate the level of returns. It may understate the risks that are involved with the investments. The companies themselves, they may not have fully audited accounts. They may not have very experienced management teams. They're not held up to the same levels of corporate governance that mainstream companies in regulated assets are, or mainstream investment funds are. So the much lower level of scrutiny means that you can either have poorer quality investments getting through to the consumer, or even investments that are basically outright scams getting through to the consumer. And often these things were invested in esoteric assets. It might be unproven technologies, perhaps it's growing biofuels, it might be new high-tech developments, maybe it's something like fine wine or classic cars. But these are esoteric assets that people don't have much experience of, so they are much harder to assess the risks of. There's no sort of background or track record you can use to help you make a decision about whether it's a sensible thing to invest in or not. So these were some of the other risks that the FCA felt was attached to UCITS and non-mainstream pooled investments. Some other investment characteristics that the FCA felt made these things too risky for ordinary retail investors. One was the time factor. It may actually be with these investments some period of time before the investment characteristics come to light, or any risks or any problems come to light. If you think of something like investing in a teak plantation or a forestry investment, it might be 7 or 12 years before the first thinning of the forest where you get your first set of returns. So until then you really don't know if the investment's been performing well at all, if the plantation's being looked after, and if the thing is doing what it's supposed to do. So the time factor was another additional risk with these investments. You may also get conflicts of interest. Quite often the distributors of these investments were also the product providers, or they had a stake in the investment. So that's a very clear conflict of interest. The distributors want to get as much investment in as possible without really thinking about whether it's right for the consumer. Their interests are aligned with getting as much money into the project as possible, not aligned with what's right for the consumer. There may also be charges attached. There might be high charges. These may add to the risk of the investment. The charges might be a little bit complex or opaque. Just like the terms and conditions, they can be hidden away in the contracts and not be that transparent to people who are investing. Or the charge may be wrapped up in the investment itself. It can be difficult to establish just how much the investment provider or the distributor or the operator of a hotel or a plantation is getting paid. Because these investments are in a less regulated environment, they're not held up to the same level of scrutiny, and so people can get away with this kind of thing in a way that they can't do as easily in the regulated world. Other problems, you may have a very high concentration of assets, so it might be a scheme that's focused on just one hotel or just one plantation or forestry investment. So there's very little diversification within the investment itself. So obviously that is an additional risk. And finally, again, because they're not mainstream investments, because they're not held up to the same levels of regulatory scrutiny, there may be very high levels of borrowing with these investments. There may be high levels of gearing, which again, when things go well, that maximises your return, but when things go badly, it does mean they are much, much more risky. So that was another issue that the FCA had with these investments. So to summarise the FCA view, because they identified all of those risks with UCITS and non-mainstream pooled investments, they stepped in with PS 1303. And what that has said is these kind of investments can only be marketed and sold to high net worth individuals or sophisticated investors. So a high net worth individual would be someone with an annual income that's greater than £100,000 or with investable assets of greater than £250,000. Investable assets means liquid-ish assets. It does not include the value of your main property. So it's quite a high benchmark actually to have £250,000 of investable assets. A sophisticated investor would be someone with extensive investment experience and knowledge of complex instruments. It really only limits it to people who are professionals in financial services and particularly in investment. So I don't really know how you go from being non-sophisticated to sophisticated, because it's quite a high barrier to get over. But the FCA's feeling was only these kind of investors have either the capacity for loss or the level of knowledge to understand these much kind of higher risk alternative investments. It's worth making a note here about appropriateness and suitability, because they're two interchangeable phrases that the FCA uses in PS 1303. Appropriateness is the kind of lower standard, and it just means, does somebody have the knowledge and experience to understand something? Suitability is the next level, and that's really talking about, is something suitable for someone's financial objectives? So for example, you could have a high net worth or sophisticated investor who would be considered able to understand one of these alternative investments, and therefore they would be appropriate. It would be an appropriate investment. But if that person had a very low appetite for risk, maybe they were quite elderly and they didn't want to take any risk with their assets at all, even though a UCITS or something similar would be appropriate for them, it would not be suitable for their financial objectives. And the reverse applies. You might have an inexperienced ordinary retail investor who has a very, very high appetite for risk, and their objective is to grow their money as fast as they possibly can, in which case perhaps a risky UCITS investment would be something that could potentially meet their financial objectives, but they would be considered not appropriate for this person because they don't have the capacity for loss and they don't have the knowledge and experience to understand the investment and to assess the risk properly. Some products that might escape PS 13.3. Basically, this is anything that is not considered to be a collective investment scheme. So a lot of property investments are marketed as direct investments. If you buy a buy-to-let property, that would be an investment. That's not covered by the FCA at all. That's your own business. Obviously, there are other regulations involved, but it's not a financial instrument, so it's not covered by the regulator, not covered by the FCA. So a lot of these alternative investments will claim that they are not collective investment schemes. You're either purchasing a property, or you're purchasing some land, or the lease on some land, or it might be real property, perhaps gold bars, fine art, fine wine, something like that. But these are not collective investment schemes. The key definitions are if there's no pooling of the investment, no pooling of the assets, no pooling of the income and profits, if the investor has day-to-day control over the asset, then we can say it's not a collective. Now these things can actually be challenged. Day-to-day control, you don't need to be sort of on site managing your hotel room every single day, but the investor does need to be able to hire and appoint their own operator. That would be something that would say that gives them day-to-day control. Similarly, with owning the sublease on a couple of hectares of plantation, having the authority to appoint your own operator if you want to, that is deemed as giving the investor day-to-day control. So a lot of these schemes will claim that it's a direct purchase of land or property, therefore it's not a collective investment scheme, and therefore it doesn't come under the FCA remit and it isn't impacted by PS 1303. Some of the other things that may not be impacted by PS 1303, loan notes and company debt. It's a bit of a grey area, but it's not a collective investment scheme, so it doesn't come under the UCITS heading and the UCITS umbrella. Similarly, membership of a company limited by guarantee or a special purpose vehicle that is actually trading assets. So it's not being used to just securitise assets, it's actually trading assets. They are all investments that would be outside of PS 13.3 and what that captures. It's very, very important for distributors to get this right though. We have seen examples where legal opinion that says something is a direct investment and there's no collective element, we've seen that challenged by the FCA. We've even seen examples where QC opinion has been challenged and reversed by the FCA. It's worth getting this exactly right, because operating a collective investment scheme without authorisation is a criminal offence. A company called Capital Alternatives are currently defending themselves in the High Court. The FCA has prosecuted them, saying that they're running a collective investment scheme. Capital Alternatives say it wasn't a collective investment scheme, they were direct investments into land and property, and so this is now being fought out in the High Courts as we speak. It's actually happening now in October 2013. If you get it wrong and you're an unauthorised person who is running or operating a collective investment scheme, you're committing a criminal offence, and it can be a fine or it can even be 2 years in prison. So it's a serious thing, and it's important to make sure, if you do believe that you're promoting or operating something that isn't a collective investment scheme, you have to feel very, very certain about that. So the implications of this, for regulated advisors, for any of the designated investments that were included in PS 1303, you can only promote those to high net worth or sophisticated investors. And you have to be very careful about how you target your promotions. You have to be able to evidence that when you promote one of these investments, you were very careful to target it only at high net worth and sophisticated investors. You can't just do a mass marketing campaign or a mass email campaign promoting these kind of investments. You have to target your audience very specifically. That means you need diligent record keeping. You also need diligent record keeping if you do have a client that you do advise on these kind of investments. Obviously, all investment advice needs diligent record keeping, but here more so than ever because of the risky nature of some of these assets. The FCA will expect financial advisors to advise upon these kind of investments. There was a period, 2011, 2012, where some advisors had an advisory business here and a non-advisory business on the other hand over here that would do the alternative investments on a execution-only basis, on a non-advised basis. The FCA would very much frown upon that kind of behaviour. So if you are promoting alternative investments, the FCA's expectation is that you are going to advise on those for your clients. You would only really expect to see alternative investments in small concentrations within a portfolio. So really we're thinking here less than 20% of a portfolio. They're there for the diversification benefits and to provide some extra return, but you certainly wouldn't expect to see them making up the majority of a portfolio. Anything that falls into this grey area where it's an alternative investment but it claims that it's not a collective investment, it's a direct investment, I would suggest that the best policy for advisors is to treat them in exactly the same way as if it is a UCITS or one of the non-mainstream pooled investments that are mentioned in PS 13.3. That's the safest way for advisors to operate. There are some other alternative investments that are out there that would be appropriate for ordinary retail investors, so for the wider market. Specifically what I'm thinking of here is physical gold. That's an alternative investment, or can be considered an alternative investment, but it's very easy to value, it's very liquid, there's a very well established secondary market, and it's an investment that's very well understood and you can find out a lot of information about it. So although that's an alternative investment, it doesn't really fall into this esoteric category where we have complex and opaque terms and conditions and we're investing in something that's esoteric and not very well understood. So this is an alternative investment that I think could be considered suitable for ordinary retail investors. Now, what I should say is I think could be considered appropriate for ordinary retail investors, but obviously the advisor would have to decide on whether it's suitable, whether it meets their financial objectives. Another alternative investment that might be suitable for ordinary retail investors would be corporate debentures. I'm thinking here quite specifically of Abundance Generation. They're a firm we work with quite closely, but their corporate debentures have a secondary market that's been established on their website. The literature supporting them is very detailed, so it's very easy to see how the investment works. They're based upon investing in UK renewable energy projects, specifically solar and wind. They're very well understood technologies, and the revenue you get from those projects is very well understood because it's based on the feed-in tariff, which fixes the price that you get for the electricity that you generate. So again, that's an alternative investment, but it's liquid, it's easily understood, we can assess the risks with quite a high degree of confidence, and they actually have quite small minimum investments. With Abundance Generation you can invest from as low as £5. So they're just two examples, but there are a smaller number of alternative investments that are going to be suitable for ordinary retail investors. The third category would be commercial property. Not something that's invested in through a collective investment scheme, not one of these high-risk, off-plan overseas properties, but traditional commercial property has often been the backbone of many, many SIPs, of self-invested pension schemes. So commercial property could be considered to be an alternative investment, but again, depending on the location and depending on the property itself, but it is an alternative where there can be an established secondary market, the investment is very well understood, it is easy to value, the terms and conditions are familiar to anyone who's bought and sold property in the UK. So that's another category of alternative that could be considered suitable for ordinary retail investors. So implications for professional introducers. If you're not a regulated advisor, then you can't promote and you can't distribute collective investment schemes. So you are only looking at those other kind of alternative investments that are direct investments and not a UCITS or one of the designated investments captured in PS 1303. But because you're unauthorised, you actually have much more freedom than a regulated advisor. You would be free to market and sell those investments to anybody at all. But of course, what you have to be absolutely clear on is that you're not giving advice. So that means you can give generic information. You can say something like, now might be a good time to invest in Japan. And you can provide information on something. So you can provide someone with information on a potential hotel investment or a potential teak investment or something like that. What you cannot do is look at someone's specific circumstances and then make a specific recommendation. That would be falling into the trap of giving advice, and if you're not regulated to do that, that is also an offence under the FCA's rules. So they're just summarising the conditions that mean that you are giving advice. If it relates to a specific investment, if it concerns the merits or otherwise of buying or selling an asset, and if you actually speak to someone in their capacity as an investor, then you've fallen into the trap of giving advice, which of course is an offence if you're not a regulated advisor. I guess one of the most common questions I get is there any role for alternatives in a portfolio? And particularly for ordinary retail investors, where the FCA has outlined quite clearly that they think that UCITS and non-mainstream pooled investments are not suitable for ordinary retail investors. So what role is there for alternatives at all? I do think there is a role for alternative investments within a portfolio, and I think that role really comes down to diversification. And I often use the example of Miami Beach. If you think of Miami Beach, you think of brilliant sunshine, blue skies, balmy temperatures and perfect weather. But of course what we know about Miami is it's on the hurricane pathway, and it will have hurricanes most years, and once every 10 years there'll be a major event. So if you build property in Miami, you have to build property that can withstand hurricanes as well as the good weather. Portfolio construction is the same thing. You can't construct a portfolio just for the good times. You have to have something in there that means you can survive market downturns like we had in 2008. The way you do that is by diversifying your portfolio. And what we're finding as we live in a more globalized world, many equity markets are becoming much more highly correlated, and even fixed income and equity assets are becoming more highly correlated. So you need additional sources of diversification to build a portfolio that can withstand those downturns, withstand those hurricanes. And so that's where alternatives come in. The difficulty in the alternatives market is because it's much more lightly regulated. A lot of the assets are direct purchase of property, so there's no regulation from the FCA. It means poor quality products do get into the market. So there is much more onus on advisors, intermediaries and investors to do their own due diligence and make sure that the products that they're considering are fit for purpose. And we do have another training session on how to assess alternative investment products. Okay, so just summarising today's session, the FCA's view is very clear. UCITS and non-mainstream pooled investments are only suitable for high net worth or sophisticated investors, and only regulated advisors should be distributing those. Professional introducers have much more freedom than regulated advisors, but they cannot promote collective investment schemes. They can only promote the other alternatives, the direct investments. But professional introducers need to be clear on two things: that they don't give advice, and they have to be absolutely confident that the product they're distributing is not a collective investment scheme, because if they are another unauthorised person operating or promoting a collective investment scheme, they'll find themselves in a lot of hot water. Now, having said all of that, as I mentioned earlier, there are some alternative investments such as gold and corporate debentures and sensible property investments that would be suitable for ordinary retail investors. You would never expect to see them taking up much of a portfolio. We're looking at less than 20% ideally, but they do provide that extra diversification benefit. Okay, that's the end of today's presentation. We hope you found it useful. If you do want any more information or if you have any questions or comments, you can contact us on our email address, which is training@intelligentpartnership.com.